Fed increased rates. We're at the highest rate hike in 22 years. Who cares? So what are you going to do about it? So the Fed increased rates again, 0.25%. That marks the highest Federal Reserve rate increase in the last 22 years. So what does that mean for real estate investing or real estate investors? Well, that means if you've historically been investing in single-family rental properties, multifamily, cash flowing real estate in general, you are probably struggling right now trying to find a deal or trying to sell, maybe even refinance the deal that you have today. So that's going to continue to be a struggle until the Fed decides to pivot away from the strategy, and they're not going to pivot away from the strategy until unemployment goes up. So if you're really concerned about your real estate portfolio and trying to figure out what to do now, just be patient. Market cycles come and go and they change, but it doesn't mean you need to be sitting on the sidelines. There are other options and other opportunities. Again, if you're investing directly into real estate, it may be challenging, but you have options of investing passively into real estate. There's a lot of real estate funds out there that you can invest in passively, and maybe they have some tools and strategies that they're executing that will allow you to make money today regardless of where we are in the environment. It really should not matter where we are in the real estate market cycle. All that matters is what is your strategy today. So you don't have to wait for the perfect market to invest in real estate or invest in general. You really have to execute a strategy and principles. And so it's the patient execution of your strategy that makes things work. So I'll give you, for example, at the end of last year, obviously we saw that rates were going up really fast. That's going to change the market. So we created a new strategy January of 2023. So ultimately, at the end of the day, when it looks like things aren't going well, you have to come up with a new business plan. And then you have to be able to pivot quickly and execute that business plan. And so a lot of people use the analogy of catching a falling knife. Well, if you have good underwriting, you can catch the knife by the handle. If you wait until all the knives hit the ground, everybody's going to jump for them, and you're going to be late to the game. So today, because interest rates have gone up, and if you still want cash flowing real estate, you need to find out what types of real estate that can you invest in that have cap rates that are higher than today's interest rate. And that's what we're talking about. We're talking about leverage, positive versus negative leverage. Residential real estate is in a negative leverage situation right now, and it hasn't been in that situation for a very long time. That means the interest rates are higher than the cap rate on a cash flow on a piece of real estate, which means you're going to get negative leverage, which means you're going to lose money the moment you put a loan on that property. So to avoid doing that, you have to invest in a property, and if it's an existing cash flowing property, you're looking at a cap rate. If it's something that you have to build and develop from the ground up, you're looking at yield on cost, which is the same thing as a cap rate, just different term when you're talking about developing a property. So your cap rate or your yield on cost need to be higher than today's interest rates. And that will allow you to get positive leverage on the property. So we switched our strategies at the beginning of this year. Instead of focusing on build-to-rent communities, we decided to focus on climate-controlled self-storage, which has a yield on cost around 7 to 8%, and to focus on short-term rental product, which has a cap rate, at least the ones our buy box, the cap rate's around 8%. That could be different for other people, but I think hospitality, generally speaking, 8% is a good cap rate if you're looking at value add opportunities. Another thing that surprisingly that I did not consider that is working well today are lot deliveries. That means home builders need more lots. They're selling houses. People are buying houses. That is going really well today, but they're running out of lots, and so I'm getting LOIs for sites that we have for finished lots and paper lots way higher than I was getting LOIs even post-recession. During the last couple of years when the market was going crazy, I was not getting offers for lots this high at that time. And the real estate market supposedly has come down since then, but apparently not for lot sales. That's doing really well. And again, like everything else, it's supply and demand. Now, one of the reasons that we, that I love build to rent communities, and the reason we started putting that together back in 2016, 2017, was because the thesis or the idea was that we were focused on entry level or workforce housing, and we had multiple exit strategies. I'm developing a subdivision and building entry-level homes, workforce housing on it. So I have all these options. I can sell paper lots on something I've entitled. I can sell finished lots. I can sell houses. I can rent the houses. I can rent them out, refinance the whole thing and keep it. So I have all these strategies and levers to pull that allow me to increase my return. Well, here we are, 2023. Now we've got a couple sites that were designed and under construction for a build-to-rent community, but now with the interest rates higher, it just doesn't pencil as well. The cash flow is not as strong now. So we took a couple of those that didn't have the cash flow that we wanted today because the market changed, and we converted them over to lot sales. Now we're selling those lots to home builders for a great profit and generating higher returns and generating those returns faster. So again, that asset class has done what it's supposed to do. The thesis proved itself out during the COVID pandemic when the market dropped, but there was still high demand for rentals of single-family homes, especially new construction single-family homes. And so it proved itself out then. Here it is in 2023. The asset classes, or this type of asset, is proving itself out again by its flexibility and ability to convert into other exit strategies to still get high returns. So we're pretty excited about that. And there's always an opportunity in real estate. That's just the way it is. And so your job is to find it. Or if you don't want to do all that work or don't feel like you have the resources and the tools or experience to do so, then find another operator who has the experience that can do that and invest with them. But make sure again their strategy works in today's market. I know there's a lot of larger REITs and hedge funds that have they're just buying apartments or they're just buying retail or whatever their strategy is. They have a mandate and they have to focus on that strategy, and it's not working today, which means they're sitting on the sidelines. And I really hate that capital markets in general and the banking industry in general is so reactive to what happens in real estate, because you get your best returns when you're proactive to what is happening and could be happening in real estate. And being proactive doesn't mean you need to be a visionary. It just means you need to be prepared for changing market cycles and to be able to adjust your business plan and your model and live while the market's going. So we're preparing for what we feel like could potentially happen next, and we don't know when it's going to happen and exactly how much the market's going to change, but we see the seasons changing, and we're preparing again now for what we think could potentially happen. And so when it does, we'll be prepared for it. That's basically what this is about. It's about these changes. The changes that happen in the real estate market are there for you to deal with. They're a part of your business strategy. They should be a part of your business strategy, and they should be a part of your plan. And if dealt with properly and prepared and executed properly, you actually benefit from these changes. So it's much better for us as investors that the market is not just a straight line, that it's volatile. That's where we make the most money. So we just have to be prepared for that volatility and look for it. It's just another day at the office.